Another episode of Paris and Bazcast, where we bring to you new guest speakers every week to talk about topics that impact property management, sales and finance. Today we are joined by Goose McGrath. Hello.
Hey, how's it going? Hey, hello everyone.
From Dashdot, property buyers agents, to talk about unicorn properties, which is quite a phenomenon.
Yeah, absolutely. First, I want to say thanks for having me here. It was a good excuse to get out of the cold depths of Victoria and fly up here to come and check it out. So I've been watching what you guys have been doing online. It's really inspiring. Seeing how much value that you've been giving to your market, so really great to be a part of it. And I guess to just kind of loop into unicorn properties, it's a bit of a funny term, and it's designed to be that, because what we're trying to do is break down a little bit of a barrier in people's beliefs, because there's a lot of limiting beliefs that people have about property and what kinds of property they should invest in, what they can do, and all of that kind of stuff. And we've actually built an entire business based around finding properties that are going to allow people to build essentially scalable portfolios. And that's requisite on having a very specific type of property that we're looking for. Now, I guess a little bit of backstory on that and how we even got to this point. So it wasn't even that long ago that Gabby and I started our real estate journey by buying the wrong property in the wrong place at the wrong time and losing our money. So it was like,
we learned the hard way.
We learned the hard way. Bought an apartment in Melbourne at the peak. All the stuff. So the cool thing about that was it was a catalyst that certainly set me and Gabby to try and work it out, because we could see all these other people doing really well in real estate, but like, what have we done wrong? And so we started trying to understand exactly what we would need to do on a conceptual level to be able to build a scalable portfolio, have it that it would actually pay us money every week, and it wouldn't be affected by external forces, because that's always the biggest thing, right? The biggest thing that is going to affect the property's value is going to be politics, economy,
things you can't control.
Things you can't control, right? These external forces. So I was like, okay, because we started bolting this concept together, and it's formed what we now call our Holy Trinity strategy, which is basically 3 parts. So positive cash flow, high growth, value add potential. Okay, so stuff like renovations, subdivisions, granny flats, under market value, things like that. And when we started putting that together, we thought, this is pretty good. As long as we can find them. We were told repeatedly that you couldn't find them, that they didn't exist. It was a concept only, which to me felt like a bit of a challenge. I like a challenge.
Find these.
I was like, we're going to work it out. I was like, because if they do exist, isn't this exactly what we'd want to do? And then we found that we could actually find them. But here's the thing: the reason that it's got the sort of mythical moniker with it as well is because they're not very common, and in fact, what we've actually worked out is they only exist in a snapshot of time.
Of course,
So they exist in a very unique point within the market where there's a certain overlap of certain economic and socio conditions that can allow you to opportunistically find these deals.
They're rare, basically.
They are rare, but they do exist. And this is the thing, a lot of people think they don't exist, and so they don't look for them. And I guess from my perspective, it's like, once you realize they do exist and you can find them, like, to aim for anything less, it's basically to aim for mediocrity, and so why would you want to do that? So does that give you guys a bit of an understanding?
Absolutely. So where are you finding these properties?
Well, so just looping back to that sort of snapshot in time component, that's a real critical part to it, because there are about 122 different metrics that we need to see in a very specific way to know that we're in this, what we call
sweet zone.
Sweet zone. We call it the optimum buying window. Now, that optimum buying window only lasts for like 10 weeks, between 6 and 12 weeks. So that means that in order to be able to continually find that, we've had to obviously build processes around that, but it constantly moves. All right, and that doesn't mean that it's anywhere at any given point in time. But so, for example, there are some pockets in and around Greater Brisbane, some of the Ipswich regions, and a few different areas. You've got to look at, as I say, there's a lot of different factors that play into it. So there's some in Queensland. We're definitely seeing some opportunities around Adelaide. A few little pockets in Victoria. But I've got to say that window is like really closing. Because part of what changes the economics around these kind of properties, so essentially what we're trying to do is achieve 10 to 15% increase in equity from the purchase price in the first 12 months.
Wow.
Right, plus positive cash flow, plus the ability to add value. So it's a pretty unique proposition, right?
Dream buy.
Yeah, it is exactly. It's the dream buy. It's the kind of buy that people think is like once in a lifetime, but we've actually built a structure around finding them once in a daytime. You know what I mean?
Wow.
So, but the thing is with that, one of the key metrics around that is buyer activity.
Yeah.
So the moment that you hear somewhere is a hotspot, I can almost guarantee you that exact day it'll stop being
a hotspot.
We'll lose it, because what will happen is the buyer activity will heat up,
Yeah.
vendor discounting goes down, and it starts to change.
Yeah. So demand builds up the pricing and.
Yeah, exactly. So vendor discounting plays a big part in trying to achieve 10 to 15%. So it's a it's a really interesting kind of thing. I mean, even at the moment, we're even seeing some pretty cool stuff in the Perth market. Obviously, that's a market that is pretty tenuous.
Yes.
Yeah.
At best, and it's going to only suit really a certain appetite.
Yeah.
Right. But just to kind of put that in context, for someone with the right appetite, and given that we're extremely diligent on the location selection, we actually just got this one deal which perfectly encapsulates sort of what we're trying to do. We actually just got this deal the other day north of Perth, and yes, it's cash flow positive, fantastic. Plus, it's in a boarding house approved zone, so we can convert the house to a boarding house. So super high cash flow, awesome. The real estate agent thought that it was zoned R20. But we knew that it was zoned R40. We checked, and they said, "Do you guys understand?" Yeah. So basically, it's a huge variable.
Yeah.
So and when we actually said, "Oh, isn't this R40?" They said, "Oh, don't be silly. You wouldn't see a property at this price.
Yeah.
R40."
Oh, no.
Anyway, and we stepped it up. She called me yesterday. She goes, "Oh my God, we've just realised." I'm like, "Yeah, contract's done. Thank you very much."
Oh, wow.
So, to put that in context, what we're trying to achieve, or the real powerful leverage that you can get out of these kind of properties, and everyone's going to be unique, right? Obviously, this property, the upside in year one is like 263% cash on cash return.
Wow.
That's phenomenal. 263% cash on cash return. So that's 263 times the amount of money that is required to be put in.
Yeah.
Is what you can take out in the first year. Like that's phenomenal. Now, to wind that back to a little bit more of a standard example, we're still looking at like 140, 150% when we can get these metrics right. So
that's still massive.
It's immense. If you think, particularly for people starting out, because I think one of the biggest problems in, look, from my perspective, from where I've come from, which isn't a real estate background, there's a lot of, I guess, thoughts around property that it's too hard, it's too expensive.
Yeah.
I'll never get in there for a lot of people, right?
Yeah.
It's a daunting task.
It's a daunting task.
Yeah. And when you don't know about it, especially when the amount of investment required for it, it's sort of, you want to be careful. You want to avoid something that you don't want to lose.
Absolutely. And particularly, like, given that most people in Australia are in Melbourne and Sydney, where the median house prices are in the 7, 8, 900s, right? So the idea of trying to get into property, you start to think, I need to save up $100,000.
Yeah.
$150,000 or whatever it is.
When I get there, then I'll think about it.
Yeah, exactly. So then there's this perpetual state where people are trying to outsave the market. I mean, I've got loads of friends that are my age that are just like, oh yeah, it's probably never going to happen for us. And I'm like, well, actually, we just need to think about it differently.
That's right.
Because when we're positioning ourselves in these markets, and this is like anyone can do this as long as you can understand the metrics around it. If you can position yourself at the right point in the market and you're looking at the right conditions, for $40,000, $50,000, you can get in there, get the right kind of property, achieve those kind of results, hold the asset, increase your serviceable income because you have positive cash flow, and get 100, 150% return on your money in the first year. So that's a way to really leapfrog your ability to build wealth and to be able to build a portfolio.
Yeah.
That's a game changer,
That's right.
So
absolutely.
And you can really grow your portfolio from there.
Absolutely. It creates this ability, this unique environment that I call fractal economics. So if you think about it, if you can buy one property and you can increase, and you can get a 150% cash on cash return in the first year, then that's going to allow you to buy the second property, right, in the first year. So then those two are going to do very similar things. So then you're going to be able to do 2 into 4, 4 into 8, 8 into 16. So it starts starts to tessellate and grow exponentially.
Yeah,
So
yeah.
Because that's where a lot of the buyers they get unstuck when they get to the second, third property. They really can't go to the fourth, fifth because serviceability becomes a big issue as well.
Well, that's right, exactly. So, you know, the stats, 75% of property investors don't get past one property, 90% don't get past two. And, you know, I would say probably 90% of the people that I speak to within our business, our clients and stuff, are people that are coming to me that have got, guess what, 2 properties and they're stuck. And they're going, hey, can you help? And I'm like, well, yeah, because even when people are stuck, if you can find the right property, you can actually... They can invest their way out of it.
Yeah.
Yeah, they can invest their way out of it as long as you can, you know, increase their cash flow position and all of that kind of stuff. Yeah. So super powerful because that is the main thing. It's obviously that balance of equity and cash flow. Because I also know some people who have gone purely cash flow plays in their portfolios, which is great, and they've actually done pretty well. Replace their incomes, all good. But it's a little bit more, I guess, weak. Is probably the right term because you're not getting that compounding capital appreciation. So it's about hitting that balance, I think. So
you got to have both.
Yeah, absolutely.
Hit the sweet spot.
You absolutely have to have both, and this is where a lot of people fall down because they think you can only have one or the other.
Yeah.
Which is just fundamentally not true.
Yeah.
So
100%.
Absolutely.
Yeah.
And in terms of the price points for these investments, what are the typical examples? Like, is it between 300,000, 500,000,
Yes.
or is that?
It is.
That's basically...
It is. We've done quite a lot of statistical analysis on that actually because, you know, there's a couple of interesting things with that. I fundamentally believe that you're better off leveraging your money to get a return rather than trying to outsave the market. So if you have, say, I don't know, $25,000, could you invest that into a cheaper asset and still, you know, magnify your returns? Yes. Quite a lot of our clients, we're buying for them in the $200,000 to $300,000 price range, which is still like that's crazy when you talk when people have got
Sydney prices.
You
get a studio, not even.
Yeah, exactly right. I mean, like, what's the median listing price around here?
Would be around
$1 million.
Yeah, so you can buy 5 of them, right?
Yeah, exactly.
So you know, if people don't realise that you can do that, and also that it doesn't have to be risky, but on a statistical analysis basis, the best value, so like the best actual like return per dollar is in that sort of $300,000 to $500,000 price range.
Yeah.
Once you get above $500,000, the yield trend starts to fall away.
That's right.
And so that's where you start to step outside that zone of getting that real balance.
So 3 to 500 is a sweet spot.
Yeah, 3 to 500 is a sweet spot. But again, like, you know, if someone's got $50,000 and they can get started in the sort of sub 300 category, it's still gonna set them up to start leapfrogging.
Exactly, because a lot of our sort of clients, when they are sort of spending around the 900 to $1 million, they could get 3 properties in the same price to be able to, you know, get a better return as opposed to just. And I guess that's the other thing that you know, we're always educating the buyers to sort of look outside their comfort zone because everyone that is living in this area or living in Sydney are comfortable with having to be able to go close to their assets to be able to see, yes, okay, this is physically what it is, than relying on someone. So being able to sort of give up that sort of control and see where else what money can buy for them, I think is definitely a key as well to identify. So having the right buyers agents to help them.
Totally.
On the journey.
Location is a really funny thing you touched on because a lot of people do say that, but I want it to be nearby.
That's right.
I usually say 2 things. I'm like, what are you going to do? You're going to go and like peek through the curtains and watch what the tenants are doing?
Exactly.
You're not,
You're
right?
not,
I want to be able to go around there and do the maintenance. Do you though?
Yeah,
like, do you really want to sign up to be a property manager?
Yeah.
And the other thing is, you know, if people own shares, like when was the last time you went and visited your shares? You don't, right?
Yeah.
So if you start to break it down into that purely that wealth building asset, take the emotion out of it.
Yeah.
That's when you can really start to open yourself up to opportunity.
I think people, they get emotional.
That's right.
Investment properties, that's where they go wrong, I think.
Yeah, totally. Which is why, you know, it's very easy to get emotional, even if you try not to be, which is why it helps to sort of outsource. You're outsourcing the emotion, basically. You know, that you go and look, I probably can't make this non-emotional decision myself, but I want the best outcome, and that's why that's where the value equation comes in.
Yeah, and that's where if you have an expert that knows, you know, what they're doing on the ground, that you can rely on, as opposed to being heavily involved. I think that's definitely a key as well, so having the right team. Yeah,
absolutely, because I think there's another really interesting thing. I don't know how we're going for time, but there's another really interesting kind of phenomena that happens with people that which is why most people get stuck, right?
Yeah.
So they'll start by going, I want to find an investment property, right? Or a house, but let's say an investment property. I want to find an investment property. Okay, so what am I going to do? And then they'll get some external force. So it could be a friend at a barbecue, or it could be a podcast, or it could be, you know, something on Facebook, right? And they'll maybe hear like, oh, I've heard this area is good. They won't know where it comes from, but it's kind of this external force.
Yeah.
And then they'll think, I'll jump on realestate.com or domain and I'll start searching for properties in that suburb, in that area. So there's the first mistake, because they start by looking for properties first, which sounds like it makes sense, but it should actually be the last thing you look for, only after you've fully qualified where exactly what you're trying to achieve and where. And so then what happens is people will find, I don't know, a cheap property or a good-looking property or whatever clicks with their psyche, and then they'll go through a process of cognitive bias where they'll justify everything. Oh, it's near a park.
Yeah.
Oh,
so
yeah. Because you jump on the internet and you can justify anything.
Any purchase.
You can prove that the Earth is flat, right? So trying to find proof to back up your decision is a really dangerous game to play, and that's where most people fall down. They go, but I've read all these articles. It's like, yeah, but how have you qualified the source of that data, and is that best suited to your overall strategy?
To your needs, because it could be for someone, but not for you.
Yeah, absolutely, 100%. You know, and not position, and people forget to position themselves so that whatever property you buy now needs to be able to buy the next one, if from an investment perspective.
That's right. It is about the next one. Always is how can you grow your portfolio, add value, and keep it growing.
Another key takeout is you don't have to have a big deposit, basically. So we're talking 30 to 50,000.
Yeah. Totally. I mean, I typically recommend people have 50 grand, but you know, it can definitely be done for less. You know, and I talk to people and who don't have that, and they say, well, what should I do? And I'm like, well, how long let's say they've got 20,000 or 30,000, and I'm like, well, how long will it take you to save? And they might say 2 years. I'm like, well, you're probably better off to do something with the money you have now and continue to save, because it's gonna magnify.
Yeah.
So
And are there any other case studies that come to mind in terms of recent successes, different particular areas that you found?
Yeah. So I mean, well, we've definitely been having a lot of success in and around the Brisbane market and the Ipswich area, and I think that's changing as well. That's sort of coming to the end of that optimum buying window. I mean, we've had clients this year alone who have bought one property and used that to leapfrog into a second property, which is great. We've had properties that we've purchased. Well, our current running under market value average is $36,450 when hedged against stuff like JLL actual valuations. So for clients who are starting out, we had one client who's like a 26-year-old mechanic who wants to get started, wants to like help his mum retire, and he's this great, like, lovely young dude, no idea what he's doing. So we got him a property which is $40,000 under market value, yielding at 6.5%.
Wow.
And pretty much straight away he's going to be ready to go in about 90 days. So, and these are the kind of situations that we're creating pretty much on a daily basis.
Yeah.
And whether the strategy that goes with it is a renovation strategy or a really low impact strategy, because like 40 grand under market value on a $310,000 house, right? And we're not just talking sort of arbitrary, like, oh yeah, I reckon it's where, like, it's a qualified valuation. If it's a $350,000 valuation, you're buying it for $310,000. That is a massive chunk. Now, so that's a value add. Renovations, boarding houses, subdivisions. These are all different strategies for different points in the journey, and obviously have different timelines with them as well. But yeah, that's we've been working diligently all year helping people to achieve these, particularly in the Bendigo region as well. We've been seeing some really amazing stuff there, particularly for subdivisions, because we've been able to really hit. Bendigo's been great up until recently. There's a bit too much heat there now in terms of the buyer activity. But we've been really able to hit those kind of 6% yields and also subdividable blocks, which is like an absolute gold mine if you can get that kind of stuff. So yeah, and for us, it's been really an amazing experience. Every client we've been working with, it's been a real journey that we've been able to help them break free from their current situation. Either say they're a young person and they're trying to get set up, and bam, we can really help them, or they're a couple and they're going to have a family and they want to transition into a new part of their life or whatever. And so being able to present these kind of different options that are going to suit is really inspiring.
So it's tailor-made, basically, customers.
Yeah, of course. Well, there's no one size fits all, right? So you've got to understand where you're at in that journey. There's no point going, oh, well, I'm just starting out and I want to do a boarding house. That's not going to work.
Exactly.
So you've got to understand where you are in the journey.
Perfect.
You want to have experts on your side.
Well, there you go. Well, thank you so much for your time. Appreciate your insights. It's been very helpful indeed. And if there's any other questions, feel free to type in through the comments and we'll get them answered for you as well. Well, thank you very much for joining us.
Thanks so much for having me. Great to be here.
Absolutely. We'll see you next week again at 3 p.m. on Thursday. Thank you.